And Steve Sharpe is our guest from the National Consumer, for NCLC, the National Consumer Law Center. Steve's an old hand at these calls and has been a valuable resource in keeping us up to date on servicing issues. We're going to be talking about the FHA waterfall and maybe the problems of the VA waterfall as well. I'm going to really just hand it over. Please put your questions in the Q&A box so that we'll be able to get to them. We'll have time at the end, and we may occasionally jump in the middle. So Steve, as always, thank you so much and welcome, and we'll hand it over to you.
Thanks, everyone. It's always a pleasure to talk with you all, especially now, as usual, but now especially because it is, again, a very challenging time. As I have mentioned before, the work you're doing now, especially to help borrowers facing pandemic hardships, is really crucial. It's incredibly important. It's especially challenging because we have this intersection between high interest rates and the presence of the Homeowner Assistance Fund to kind of help borrowers navigate that, work through these two systems is really hard, and it's really takes people having a trusted housing counselor or a legal aid attorney to do that work with them. So just, I thank you for everything you're doing. Want to today focus on federal loss mitigation updates to let you know some of the changes that have happened in the past couple months. Again, this is always sort of in the backdrop of helping people navigate what's available from the Homeowner Assistance Fund and then what's available through the investors. So hopefully with some of these updates, you'll be better equipped to help people do that, and kind of talk about what's available, what has changed. We will spend most of the time talking on FHA insured loans, but we will have some time to touch a little bit on the VA and maybe even on Fannie Mae and Freddie Mac. Again, my email is there. You can contact me. Can help in a kind of consulting way, but I do think that I've been able to help, kind of talk through some of these things, especially if you have questions afterwards from what I've said. So without anything more, why don't we go forward and hit the agenda? So let's do next slide. So there have been 3 big mortgagee letters since the beginning of the year that kind of cover all aspects of FHA loss mitigation. So we're going to talk about those. A USDA update and actually a VA update that goes along with a companion on forbearance access, and then chat a little bit about what's happening in the VA guaranteed side. And again, a plug for contacting me if you are having trouble with VA loans. I won't have any magic to provide, but I can help talk through what is available. And then we'll do a little bit on other loss mitigation. So let's do next slide. Okay, a reminder. If you've been on these with me before, you have heard me say this, but I cannot stress enough that it is crucial when you are helping a borrower with a mortgage servicing issue, when you're helping them try to access loss mitigation, to help them try to figure out what is available just by virtue of being behind with a particular type of loan. First thing that I suggest doing is trying to figure out which rules apply. Who is the relevant owner and investor? Specifically, do either the Fannie Mae, Freddie Mac, FHA, VA, or USDA guidelines set the terms of potential loan workout? This is important because we do not have complete alignment. What is available for a Fannie Mae borrower different than what is available for an FHA borrower. And it's very frustrating for clients, especially if they have the same servicer as their neighbor or someone else and get something completely different. Because if they have a Bank of America or Cenlar or Mr. Cooper or any of these, the servicer is not generally the entity that determines the rules. It is who the investor is. So just quickly, Fannie Mae, Freddie Mac, you can use their online loan lookup. FHA, VA are generally pretty easy to determine from the face of the documents. USDA guaranteed takes a little more work. If you do think you have a USDA guaranteed loan, let me know. And USDA direct, very easy because they are paying the government directly, the United States directly for that. But identifying that investor is a crucial first step. If they do not have any of these federally backed investors, then they are likely in a private label or portfolio situation where the loan is owned privately. And unfortunately, right now, we do not have publicly available rules for what those borrowers should receive. Often it is hidden or shrouded in secrecy what private label securities or portfolio borrowers are entitled to receive. It's a much harder situation. So, and in those cases, maybe without knowing, those are really the cases that you want to use for half. So there's a question: how do you find out who the investor is? Is there a central site to where to look? No, unfortunately not. Unfortunately, if you kind of have to keep the main federal investors in mind, these ones I have listed, and either look at the terms of the documents, whether it's got FHA insurance on it, whether it's clearly VA, or use Fannie Mae or Freddie Mac's loan lookup, which you can Google. And those are the kind of main ways to do it. It's challenging, but it is definitely something that is important because it does determine what type of loan it is. You can also ask the servicer, and maybe they will tell you, but of course it's challenging, as you all know, sometimes to deal with frontline servicers. So if you have trouble with this, let me know. Maybe this could be something to go into a little more depth, but right now I do want to move forward because we could spend all time on this. Sometimes, yeah, the common practice of having to request in writing, unfortunately, that is why you want to try to use some of these other external ones. And maybe it's worth kind of talking through. I think I have done that for this group before, but it could be worth a refresher. So let's move to the next slide. And of course, keeping all that in mind. So main point of today, there have been very significant updates for FHA insured loans. Often pretty easy to tell if it's an FHA insured loan because at the borrower will be paying an FHA premium. Usually on the documents, there is noted an FHA insured case number in both the note and the mortgage. Usually it's in the closing. Usually the borrower knows. There are this challenging subset of loans that used to be FHA insured that have been sold off. You would probably learn that eventually in working with the client. But we won't cover those today. Those sales haven't been happening in a while. But we'll focus on these FHA insured loans. Again, pretty easy often to tell if it's FHA insured. So big updates here. The main update, I think, kind of flows into everything, and that is the COVID recovery options, including the COVID recovery modification, was clearly stated that the options may be offered through October 30th of 2024. So we have more than a year where we are certain that COVID recovery options can be made available. They have to be completed into February 27, 2025. So we have some good information about the COVID recovery mod and how long it would be available. So that's a big takeaway. But from there, we get some other important developments. So next slide, please. Let's first recap what the COVID recovery mod does kind of at a very high level. So the idea here is through the recovery modification, it targets a payment that achieves a minimum of a 25% reduction in principal and interest. So this is a modification program that does not based on what the borrower's income is. It doesn't generate a payment based on income, but instead it generates a payment by targeting a 25% reduction to the principal and interest. And again, this is for FHA insured loans. What is crucial to understand is that a target is just that. It is a target, not a guarantee. This does not mean borrower will receive a 25% reduction in principal and interest with a COVID recovery mod. It means the system is aiming for that. And unfortunately, then this is the question, unfortunately, the rise in interest rates, the increase in interest rates make that target much, much harder to hit because because of how rates are set for FHA insured modifications, which are based not on the borrower's note rate, but on the, in fact, what the Freddie Mac primary mortgage market survey says. The increase in interest rates make that target much more challenging to hit. In fact, you have borrowers, if they are just applying for COVID recovery mod or asking for it, may see an increase in their interest rate, which makes hitting a reduction target much more challenging. Quick aside, that is why I said the thing up front, why you all are doing very important work, because you need to keep that in mind when you're trying to help a borrower toggle between whether half is available, if you're in one of those states that can combo maybe, or whether they need a modification. The target is much harder to hit. The target is achieved through a few means, maybe through a term extension, an interest rate, like I said, though this is challenging, or using a partial claim, that payment to HUD to defer part of the loan to the end at 0% interest. Those are how you hit the target. And the rate increase definitely makes that more challenging, but also often people have come in to this with previous loan modifications, and previous modifications can impact what is available. They may have already had their term extended. They may have already used that partial claim. So this becomes very challenging, and why the target is just the target and not a guarantee. So that is what the COVID recovery mod, the modification, aims to do. The standalone partial claim is that tool just to bring the loan current through the partial claim. These options are now available at least through October of 2024. But more important, there's another step to this, and let's go to the next slide. The other major thing that the mortgagee letter did is suspend FHA HAMP. So prior to this mortgagee letter, you had two systems in place. One for COVID affected borrowers, and one for borrowers who were not impacted by a COVID crisis. What Mortgagee Letter 2303 did is make everyone reviewed for COVID home options, even if they are not facing a COVID hardship. It makes one waterfall now for FHA borrowers. It becomes finally effective in 3 days. April 30th, 2023 is the mandatory effective date. Many servicers have already been using this. So all borrowers now reviewed for COVID recovery modification options as their loss mitigation option. Really big change. So just keep that in mind, that's where you look. This even includes borrowers impacted by a presidentially declared major disaster area. So even our disaster impacted borrowers, everyone is going to be reviewed for the COVID recovery modification until October of 2024. And of course, by that time, we would expect something else to come along. But that is what we are dealing with now. So that is a big change. If you have one takeaway from this, that is the big change coming in up. There are some you have to look at the mortgagee letter, especially if you are currently helping someone. So if you have a borrower currently under review, you just want to check the mortgagee letter, and these are easily Googleable. You just want to check the mortgagee letter to see how that impacts borrowers who are currently under review, but just something to keep in mind. Okay. So I'm going to pause here, just looking at the questions. Some borrowers are not accepting the HAF and loan modification simultaneously. Unfortunately, when it comes to the combination of HAF and loan modifications, often it is very, very challenging to combine those two because of HAF policy combined with, or the state policy combined with the how hard it is to get servicers to move forward. So it really is a state by state basis. And in some states are not even allowing that. You all probably know the landscape of that better, but it is very challenging to combine the two, and in some states, not even possible. This change will affect borrowers who are not affected by COVID. If you have a borrower after the April 30th effective date who has some other hardship, they are going to be reviewed not under FHA HAF anymore. They are going to be reviewed for COVID-19 home retention options, even if their hardship is not related to COVID. Let's go to the next slide. So you're probably asking, like, what practical impact is that? And the main way this impacts borrowers is probably not in the actual terms they will receive, because while there may be some differences, the offers under FHA HAMP and under the COVID recovery mod will be generally the same, or really close. What this really does is increase borrower access to streamlined loss mitigation. That is where this is really, really going to impact. Because as I think we've talked about in previous sessions, but as you probably all know, borrowers accessing the COVID recovery mod do not need generally to submit financial information. They access the COVID recovery mod through a conversation with the servicer in which they indicate what they can afford. That is how the COVID recovery mod worked. FHA HAMP, especially for those people who have been doing this for a while, as we know, required submission of financial documentation and then an analysis based on that documentation. That, because of its suspension, is no longer required, meaning all borrowers should now have access, once this becomes in mandatory effect in 3 days, to streamline loss mitigation. I think that makes a big difference. As someone who worked as a legal services attorney for 15 years, I know just how challenging it is to get borrowers to submit financial documentation and servicers losing it and the whole runaround you all know. Opening this up to streamlined offers should make that process much easier. So that is the thing to know. I think that this Mortgagee Letter 2303, the big takeaway, the big change, and one that I think should be interested to monitor how it actually works for people. Again, it becomes more challenging if you've got someone who's already under review. The Mortgagee Letter talks about how servicers should handle borrowers who are already under review, but want to talk, at least understand kind of FHA HAMP suspended, all borrowers reviewed under COVID waterfall, except those people who are currently under review, maybe it's a little different. And all these borrowers should have access to streamlined loss mitigation offers. This is a big change. It's at least open until October of 2024, and it'll be interesting to see how this goes. Just as a side, it was opened up by a recent CFPB RESPA guidance that kind of allowed this to happen. And FHA, in response to the CFPB's RESPA guidance, really moved forward and said, this is something we're going to do. So I think I'm looking at the questions. I believe we have answered all of those in there. I guess the other, can a half award and a loan modification be used consecutively instead of concurrently? Great question. Let's move forward because we will cover that a little bit. Next slide. Okay, great. One of those great leading questions. So the other thing that this changed is adding imminent default to COVID loss mitigation. So before this, if you had a client who wanted a COVID recovery mod, but hadn't yet defaulted, but was in imminent default, meaning there was clearly grounds for knowing that this person was going to default, that borrower could not access COVID recovery options. This mortgagee letter changes that to bring COVID recovery options in line with FHA HAM, which does allow borrowers facing imminent default to access a loan modification. So that may answer the question about can they be used consecutively or concurrently. Concurrently is that question we had before, which really depends on what's allowed by the state, particular state HAF, and can you combine these things. But as far as consecutively, what this can allow is a borrower who receives a half payment and has a loan that is still absolutely unaffordable to then proceed and ask for a loan modification, as long as you meet the requirements for imminent default, which are talked here, and fill out a trial plan and complete a trial plan. So that's a big change. Huge practice point, huge point. You really need to make sure that client, though, understands what may be waiting for them if they ask for a loan modification after bringing their loan current. That has to do with interest rates. You have a client, a borrower who is sitting at a 3% interest rate, gets brought current with half, and then is like, ooh, I'd sure like to see if a loan modification is good for me. Just recognize that that borrower may be walking into a doubled interest rate. You know, they could be getting a 6, maybe 6.5, maybe a set, like a very large jump in a rate. Now, through term extensions, through deferrals, through partial claim, maybe they get payment relief still, even though their rate increases. But based on what the market is like right now, I don't know if a borrower is really interested generally, let's say, in a $15 a month payment based on maybe they get like a modification that just increases or decreases their loan very small amount, but it would result in a much higher payment. So, it just comes to just how challenging this environment is right now, and how hard it is to be you all in trying to help people navigate this. So yes, you can now get more easily a modification after half, but boy, people really need to be aware of what they may be signing up for. And again, maybe this is just needed. Everyone's situation is different. Maybe they're not going to be able to keep the house unless they have a payment reduction, and maybe a payment reduction is even possible depending on what's happened. It's just important to recognize what that may mean. So let's go to the next slide before we get into some of these questions. These are just some provisions about borrowers in foreclosure. I don't think we need to walk through these specifically. I just wanted to highlight them for you because it can be useful to see kind of what the mortgagee letter says about asking for relief for borrowers who are nearing a foreclosure date. So just remember it's in the slides. Probably want to go back and look at this on your own sometime, but do just want to highlight that. So let's just go, we don't need to go in detail there. Let's go to the next slide. The other thing this does is allows for an increase in how much partial claim a borrower can receive. So the partial claim, again, is that amount that is broken off from the loan and put at 0% interest at the end, payable in a lump sum, and requires the borrower to enter a new contract with HUD. The partial claim is generally capped at 30% of the unpaid principal balance, but for COVID options, it was previously limited to 25% of unpaid principal balance. HUD has gotten rid of that 5% difference, and now borrowers seeking relief under the COVID recovery mod can go for the full amount. So that can open up some partial claim availability for some. If you have a borrower who had a previous COVID modification, maybe they reached that 25% cap, but now they can get a little more partial claim availability. Just an FYI that is part of the change as well. Next slide, please. Okay, so there are some open questions. We don't have a lot of guidance on this. We sent some comments to HUD in response to 2023, and we're going to look at your few more questions in the chat. I think if you submit an application with financial documentation, they should review you for the COVID recovery modification once it becomes effective in 3 days, finally effective in 3 days, but it's not entirely clear. I hope that one HUD resolves it. There is this challenging situation of modifications that involve a payment increase, and whether that can be done through streamlined options. That is not an FHA waterfall. The FHA waterfall allows it, but there is this issue with Regulation X. If this is, I'm hoping that the next mortgagee letter will limit the amount of those payment increase modifications. But if you're seeing a lot of payment increase modifications where that's the only thing the client can get because they can't get half for some reason and they have really used all their other options, we're still trying to get guidance from HUD on how to deal with that, and that's still an open question. Successors and interest, there is just released an FAQ that may make this challenge really challenging, kind of limiting successors and interest options for borrowers. So these are people who take their property, take over the property as an heir, and then want to simultaneously modify and assume. What I would say is, if you are seeing successors and interest issues and the servicer is saying that nothing can happen, I would make the servicer ask for a variance, maybe complain to HUD about this, use the National Servicing Center. You may have to do some extra work to try to address successors and interest. You can see our comments on all of these topics at the link. But let's just see what we have in the chat. So client under review this week was offered a loan mod without financial documents with a trial plan of $5 for 5 months. Of course, it's hard to know what the situation is. That's really interesting. I wonder if that is an FHA insured mod. Most FHA insured mods from the COVID option should not require a trial plan unless it is an imminent default. So I guess it just depends on what the investor type is there. Of course, it's tricky if that's going to be the actual modification payment going forward, but you may have to just look really closely at those terms with the client. Is it a guarantee that the rate will be increased now or a possibility? This is a great question. It really depends on the investor type about whether there's going to be an increased rate or an increased payment on a modification. Of course, it depends on what the current note rate is. we probably still have borrowers out there with 7 or 8% interest rates, though probably not very many. You want to see if, of course, what the client's terms are, but I would just warn you that if it's an FHA insured loan, often, or a VA guaranteed loan or a USDA guaranteed loan, that you may be very well seeing, and they are allowed to charge increased rates if that's what the market dictates. So I do think it's maybe it's not 100%, but it is quite often, especially in VA, FHA, and USDA space, that it will. A note about half in Oregon, so that's important. Are servicers opposed to doing a partial claim over loan modification? Seems like servicers want to do loan modifications as to make money. I think that's interesting. I think it really depends on the investor type and the structure of the servicer. So I don't know if there is a general idea here. I think you do just want to, though, understand what the waterfall says and ask the servicer to do what at least is dictated by the waterfall. Let's move forward, because we still have some more slides to cover and about 20 minutes, so we'll move forward. So this may be seem a little technical, but I do think it's important to try to understand the change here. I don't find it myself to be very intuitive, but I do think it's useful. I would say the punchline here is you may have more clients that are able to access a 40-year modification if that is helping them achieve payment relief. So let's kind of walk through that. So there is a very definite change. What happened is there was a regulatory change, and it means that now for all types of FHA insured loans, still in FHA insured land, you can have modifications that go to 40 years. We're not talking about making loans, we're talking about loan modifications. So now for FHA, it is pretty clear that throughout FHA, you can have a modification that can go to a 40-year term. Just as a side note, this is already the case with Fannie Mae and Freddie Mac loans. Next slide. So what's interesting here and kind of very technical is that the COVID recovery mod had already incorporated a 40-year modification in. However, it didn't do that for everyone, even if that would have helped reach the target. So once this regulation was in place, HUD made a slight change, but a very important change to the waterfall for the COVID recovery mod in step 5. So we'll walk through that. Next slide. Before this mortgagee letter, which I believe becomes mandatorily effective on May 8th, so again, very soon, you could only reach a 40-year term if you had some partial claim availability left. So as I said before, a bit before, there is a cap on the amount of partial claim that is available for a borrower based on the borrower's unpaid principal balance. So before the reg change, you needed some amount of partial claim availability in order to access a 40-year. But after HUD issued its regulation and released this mortgagee letter, borrowers who have already reached their partial claim max can now access 40-year terms, even if they don't. So even if they don't have any partial claim left, even if they've reached their max. So this is important for a particular subset of borrowers who, and probably the people who needed 40-year mods the most. So prior to the change, if you had a borrower who had completely maxed out their partial claim, kind of had all levers pulled, had kind of the full types of changes that can happen for an FHA insured loan, those borrowers, if they defaulted on that modification, were shut out of a 40-year term. Unfortunately, those were the borrowers who really needed the 40-year term because they had already done everything else. So this change is important for those people because now they can access a 40-year modification term. A subtle change, but it can be kind of an important change for a particular subset of borrowers. Let's go to the next slide. Like I said, it is those borrowers who really needed the 40-year term who were shut out of it who can now access it. So we're hoping that that will reduce the number of borrowers for whom FHA modifications increase their mortgage payments. And no one thinks that's a good idea. There is a important caveat to this. And you probably are already somewhat skeptical about 40-year. You may already be somewhat skeptical about 40-year terms. I know clients don't like them because they don't want to have it all the way up to 40 years. The reason to have it is it just provides another way to reduce payments because it lets them extend payments over a longer time. But again, it is a mixed situation that it doesn't necessarily feel like the best thing for borrowers. And this gets into a comment Diane made in the chat. It isn't all great anyway, because servicers can charge a slightly higher interest rate if they offer the 40-year term than if it is a 30-year modification. Has to do with how the market works. Won't try to defend or say that. It's just, and in fact, we have asked for a reduction of that, but that hasn't come through. So one problem with the 40-year term is that the servicer may charge even a little more interest. And so if you look at Diane's comment, the client offered the mod that increased the rate from 3.5% to 7% and extended the term to 40-year. Probably some of the reason it went up to 7 is that it can be charged a little higher for 40-year. This goes back to what I said right at the beginning. Y'all are doing extremely important work. Is helping clients navigate the situation is really, really important for them to have an ally, a housing counselor, a trusted housing counselor, because it is a challenging situation. It is the reason that borrowers should think very long and hard about HAF if they are trying to pick between HAF and loan modifications, because it's so challenging to deal with the loan modification landscape that we're in right now. If things go with the 40-year and then things get better for them, are there penalties for early payment? No, I don't. So we're in FHA insured land. You got to look at the prepayment penalty situation. I don't think that's really the issue. The borrower may, in that case, hopefully their credit has gotten better and they can maybe refinance. But it's really hard because we don't know where rates are going to be over the next couple of times. So really, they need to think about what their think about what their financial situation is now and what they can afford. So let's go to the next slide. So just want to say one thing. So we have talked about mods. We are rightly talking about modifications because loan modifications are, it's even more important to understand loan modifications in a high rate environment, because it then becomes more important to think through with the client how to weigh the options. If it's a loan modification in a low rate environment, well, you know, it's just a whole different situation. When it's a high rate environment, that's when you really need people to help you kind of go through the pros and cons. So that's where we wanted to spend the most time, and that's where we spent it. But we do have some other topics to hit. At first is on forbearance. This is not a modification. This is the temporary suspension of payments to give the borrower time to recover, not canceling their payment. They still have to do something at the end. This is forbearance plan. So important announcement from FHA in 2308. First, they are stating now a definitive cutoff for when a borrower can get a COVID forbearance plan. Those are usually more quite quick. Should be very streamlined to access. They don't get into all the other FHA policy on forbearances. A COVID forbearance, you have to ask for it by May 31st, 2023. You do need a COVID hardship to get a COVID forbearance. So FHA set the cutoff in Mortgagee Letter 2023-08. I also suggest looking at their chart, which is in the Mortgagee Letter, because I think it kind of gives you a helpful understanding of how much forbearance is available for borrowers. And the big change very recently, USDA followed through pretty quickly, but VA announced that they were doing a similar deadline just a few days ago, and it's through Circular 262308. It's so new, I've barely had a chance to look at the circular, but there is the link. So just an understanding, forbearance, COVID-related forbearance, the government insured investors, FHA, USDA, VA, have set a May 31st, 2023 hard cutoff for that. So just keep that in mind as you're trying to help folks. Another change. All right, next slide. So that's sort of it on the updates. And like the title said, most of what I want to talk about, most of the big changes have been in the FHA space. I hope it's been helpful. Wanted to just touch very quickly on the situation at VA loss mitigation. You can please let me know if you've got VA, if you're struggling with a VA case. There's probably good reason for that, because it is a very challenging situation for our veteran borrowers. And this is, again, borrowers who have a VA guaranteed loan. Very easy to tell if it's a VA guaranteed loan. It's basically plastered on the loan documents, and usually the borrower knows. What I will say from a very practical matter is, if you have half funds available, you should very, very strongly consider VA borrowers for half funds if that's available, because the modification system is very challenging right now, which is a shame. We did some recent comments with the Center for Responsible Lending on what we think is going on in the VA program, in case you're interested. But let's talk about a few details what that means. So next slide. So there's no partial claim available now for VA borrowers in order to bring their borrowers current with that payment, kind of a 0% chunking off a portion of the loan, putting it at the end at 0% interest. There was a VA partial claim program. It was rescinded October 28th, 2022, and we don't have an update on that. So unfortunately, that is not available. And you'll see in our letter that we have tried to push the agency to make that available. Of course, HAF does a similar thing, but it's really challenging if you don't have HAF funds available, or if there's some other reason why the VA guaranteed borrower can't access HAF. Let's go to the next slide. Moreover, the VA's version of a targeted payment relief option is also set to expire very soon, July 1st, 2023. And in fact, because servicers are not absolutely mandated to provide the modification through the end of the date, some servicers are not have discontinued offering it even now, which makes the situation very, very challenging. What the VA circular did was also allowed some deferral, or some setting aside refunding of payment and setting it at 0% interest, which would help achieve a payment target. But that's set to expire soon. And so the other problem is VA is similarly similarly has the same kind of interest rate policy as FHA. So it's really rough right now. And I'd say if you can get half, that's great. Again, I see a point that VA that the servicer's not accepting half partial half funds. One thing you can do is every VA guaranteed borrower who goes in default has a VA technician assigned to them. That is someone at the VA who can try to help problem solve. So you can, your client was notified who their VA technician was, but probably lost the letter or whatever. You can Google how to contact a VA technician and try to get help through them. Just Google VA home loan technician. But it's just it's hard. We're spending time trying to work on it, but so it is just a very rough time for veteran borrowers. I think you can let your elected officials know, of course, and try your best, but it is a rough situation right now, and half can often be the best option available for them. Let's go to the next slide. Just a note. Oh, I should have said USDA guaranteed, because USDA direct is a whole different situation. Just letting you know that COVID relief is explicitly incorporated into the USDA guaranteed program. There it is. It does only, so unlike FHA, it only applies to borrowers impacted from a COVID-19 emergency, meaning it's not like the folding of FHA HAMP. Just wanted to let you know that USDA guaranteed program does have an option available for COVID impacted borrowers. Next slide. And for Fannie Mae and Freddie Mac, there is still the deferral and flex mod available. The stuff. So the thing to say here is that Fannie Mae and Freddie Mac have also not followed FHA's option and made all pandemic relief available to all borrowers. Still, there are some subtle differences for those borrowers who have a pandemic hardship versus those who don't have a pandemic hardship. It's especially different if you're trying to get the deferral. You can get there's more months deferral available for COVID impacted borrowers. Flex modification, because of how rates are, is generally the same. One very important note, pretty much the main thing to know right now about Fannie Mae, Freddie Mac. Borrowers with Fannie Mae and Freddie Mac loans are allowed to keep their interest rates if they are below the market rate. So repeat, they are allowed to keep their interest rates. They're not going to face the same interest rate increase pressure as FHA and VA. There are finance-based reasons for that, but it is a better situation for Fannie Mae and Freddie Mac borrowers. Next slide. As I think we hit the end. Again, my email is at the front of the slides. I think we have 5 minutes. I think I've got most of these questions, but I see the one, does COVID forbearance require proof of COVID hardship? I'd say this is the answer, that under the CARES Act, you shouldn't need documentation of a COVID hardship. So I think for those people who are trying to hit into that deadline, you shouldn't need like a documented hardship. It should be in that streamlined forbearance. So let me look at this other question here. Permanent target payment is not reposed. Servicer students offer a mod if borrower can choose to accept it as affordable. Yes. So the question is, should there, under FHA rules, if you can't hit the target, which again is going to be the vast majority of people, should there still be an offer? My understanding is like the questioners, which is yes. Under the waterfall, there should be a modification offered. As a general matter, you should offer the best possible modification. It gets challenging, very challenging actually, if the best offer is a payment increase. but that does not have to do with the FHA mortgagee letter. It has to do with the Real Estate Settlement Procedures Act and when you can offer a streamlined modification. And there's limits in RESPA about offering a streamlined modification if it increases the payment. This can be a very challenging situation to deal with practically, having to do with RESPA and what servicers can do. Maybe that is the kind of situation where you would have the client submit documents so that you're not trying to say this is like the streamlined offer. There are different ways you can do it. If it's the best possible offer, you could say, well, that's still allowable under that. But just recognize that it's not that Jared in the question is actually reading the mortgagee letter correctly. But when it's an increase, it can be other law that's causing the problem. If this is happening to people, let me, you can kind of, if you need me to walk through this, probably easier to do over the phone, especially with only a couple minutes left. But the short answer is, Jared, you are reading the mortgagee letter correctly. And again, importantly, that is for FHA insured loans only. Actually, if it's a Fannie Mae and Freddie Mac, Flex is only available under those rules if you can achieve a payment decrease. So, or maybe equal or decrease, but you can't be up. Which again is a reminder, kind of a final reminder to always check the relevant investor, because all of this very much depends on that. So I think that's probably it. I do think that it's been, I hope this has been useful. Again, you have my contact information, and I believe the slides will be circulated. So I will pass it on to Ebony or Bruce, but thank you very much. And it's been fun as always, and I hope it's been useful.
Excellent, Steve. Very, very helpful. We are always appreciate all the kind of deep dive here. And just